G'day everybody and welcome to another episode of the Aussie Dividend Machine. Thanks for joining me in this one. Today we're going to look at 3 of my top ASX growth stocks. These stocks have great potential for growth in the near term and then also have a good chance of delivering us good dividends in the long run. 2 of these stocks I think are worth purchasing right now, and one of them is a watch and wait. This has to do with their financial records and whether or not there's enough information there for us to make a good decision before purchasing a stock. For the ones that I'm comfortable purchasing now, they've got a good financial track record and we can tell what their future value might be from their current results. The third stock is yet to post some solid financials, but I think they've got some really good opportunity for growth. For this reason, I'm waiting for their next lot of results to come out, but we'll get to that later in the video. As always, this video is for entertainment purposes only. I'm not a financial advisor, so before you make any investment decisions, make sure you do go and see a fully licensed financial advisor. With that said, I'll give you all the facts I can about these companies so you can see what their growth potential could be in the future. Don't forget to give the video a like, and if you're enjoying the content, please subscribe to the channel. With that said, let's get to stock number 1. So the first growth stock I wanted to talk about today is Northern Star. Northern Star is a mining company that operates in Australia and also the US. They own and operate low-cost, high-quality underground gold mines. They have a large amount of proven gold reserves on their books, and their long-term growth has been excellent. They have a solid track record of profitability and stability. Their price in no way follows a cycle, and it has been good, consistent growth for over the last 5 years. Even the recent COVID-19 outbreak has failed to put a damper on their growth. If anything, the COVID outbreak has pushed their price higher. This is due to the increased demand in gold that we're seeing at the moment. The one thing I really like about this company is their ability to build shareholders' equity. They've been doing this without fail year after year for the last 10 years, and the rate of equity increase is unbelievable. I'll put the figures up on the screen so you can see for yourself just what an amazing job they've been doing in building equity for shareholders. They also currently pay out a modest dividend of about 1.2%. As their investment in expansion and operating activities slows down, I would expect to see that dividend yield rise significantly in the future. We could expect the dividend yield to rise as high as some of the other big miners in Australia, such as BHP and Rio Tinto, who pay well over a 5% dividend. For these reasons, I think Northern Star is a great share to purchase at the moment. Given their growth rate, I think their current price is reasonable. I think we'll see a lot more growth out of this company and the share price will be more than justified. Now, Northern Star's ex-dividend date is on the 8th of September. Once this date passes and people no longer have access to the current dividend, we might see a small price drop in Northern Star, and this could present a great buying opportunity, so make sure you look out for that. Let's move on to the next company on the list. The second company I wanted to talk about is Pushpay Holdings. Pushpay Holdings operate a donor management system. This serves companies in the faith sector and also non-for-profits. It is essentially a platform to collect donations. As you would expect in the past year, traditional collection plates or cash donations are going out of fashion very quickly. This is obviously due to virus concerns. This has set Pushpay up for some great growth as more and more people switch to their platform as a method of donation collections. Now, the thing I like about Pushpay compared to Afterpay or Zip or some of these other payment style companies is that they've been recording a profit for some time now. This is important to me because I feel it gives you certainty about the direction of the share price. They're currently operating in Australia, the US, and Canada, and I think there's further expansion to come for the business. I estimate their current conservative growth rate to be around 20%, and at that growth rate, you can definitely expect some pretty tantalizing capital returns. When you look at the company's top shareholders, you'll notice that institutional investors are not fully invested in this company yet. This is good for savvy investors because if we can get in before the institutions do, then we can expect to see a massive price increase once the institutions do decide to start purchasing the share. I think with its current track record, that's something that is likely to happen in the near term. At the moment, Pushpay are not paying a dividend, and I would expect this from a company that's still expanding and growing. However, in the long term, I could see Pushpay having quite a bit of excess cash as they have very low overhead costs. Hopefully with this excess cash, they'll either buy back shares, which increases the capital value of the stock, or they may choose to pay it as a dividend. I think this is something that could definitely be expected in the long term from Pushpay. I'll put up some figures on screen for Pushpay which have indicated to me that this company is definitely a buy. How about their price? Well, at the moment, I think their price is quite reasonable. If we use the growth rate of 20%, which, as I've said, I think is quite conservative, we are still getting Pushpay at a decent discount at its current market price. Even if they do fall a little bit short of this growth rate, there's still a little bit of margin for error. This is a stock price that I'm watching with a keen eye in the near term, and it may be a company that I choose to purchase quite soon. Let's move on to the third and final growth stock on my list. Bubs are involved in the production and sale of infant formula. This is a category with other competitors such as A2 Milk. Bubs has recently signed local market deals with Chemist Warehouse, Woolworths and Coles, and we're starting to see it become ever more prevalent in these retail outlets. They do have a very tough competitor in A2 Milk, but given A2 Milk's near 55% profitability margin, I think that there's definitely room in the market for more than one player. Now, Bubs is not yet profitable, but they are very, very close to being. In addition to this, their debt levels are extremely low, and for these reasons, I think Bubs could warrant purchase even before they turn profitable if you want to get them at a very good price. Now, the other thing I like about Bubs as a company is their supply chain. I'll put up an image that I saw in their 2019 annual report, which shows you each step of their supply chain. The company has been working hard to acquire every single step so they can have ultimate control over the price of their product. This is very different to A2 Milk, who chooses to outsource a lot of the different key items in their supply chain. It'll be interesting to see how this benefits Bubs, whether it is actually a positive or turns out to be a negative in the long run with the higher operational costs. It will, however, give them better price control over their product, and they may be able to undercut the price of the A2 Milk products. So their revenue growth is also impressive. It was up 168% from 2018 to 2019, and that's been an ongoing trend for them. So all the valuation metrics are looking good for Bubs, but we just need to see them turn a profit. I think as soon as they post a profit result, we'll see the share price go up exponentially. Now, their 2020 annual report comes out on the 8th of September, so this is one I'll definitely be looking at very closely. In my own personal investment approach, I generally stay away from stocks that are yet to post ongoing, consistent financial profits. However, in this case, I think this company's on a great path, and I think with their low debt levels, the risk in buying Bubs in the near term is lower than it would be for a lot of other speculative companies. For this reason, they make my top 3 growth stocks list. Well guys, I hope you enjoyed this video and learned something along the way. If you've got anything further to add about any of these 3 companies, please let me know in the comment section below. And if you've got any questions about my analysis on these companies, please also let me know below. As always, thank you very much for watching. Stay safe, and I'll see you in the next video.